right, but these are under the radar stories. These are stories that are flying under the radar, but today it's not under the radar. Today it is front and center, front page headline news.
Right.
And we are actually going to have somebody that can give us more input because I never like to tell these stories without getting an expert on the line. And so we are going to have that for you later this morning so that you guys can understand. Art Hogan is going to be joining us.
Okay.
And he's going to explain what's going on with these banks because I know a lot of people are really upset and a lot of people are nervous. I saw that they had people pulling their money out of banks.
Yeah.
Right now. But a bank collapsed. And this bank, Silicon Valley Bank, is a huge deal. It was founded in 1983. It specializes in banking for tech startups.
Right.
That bank also provided financing for almost half of U.S. venture-backed technology and healthcare companies. So outside of Silicon Valley, it was relatively unknown, but it did have $209 billion in total assets at the end of last year, and it was among the top 20 American commercial banks. But what happened for this bank to fail? Well, there was a Federal Reserve. Interest rates started getting raised a year ago to help tame inflation, and that also sapped the momentum of tech stocks. And those tech stocks had benefited Silicon Valley Bank.
Okay.
Higher interest rates also eroded the value of long-term bonds that the bank and other banks had gotten during the era of ultra-low, near-zero interest rates. All right, so at first, the $21 billion bond portfolio was yielding an average of 1.79%. The current 10-year Treasury yield is about 3.9%. At the same time, venture capital started drying up, so startups had to draw down funds that were held by Silicon Valley Bank. So there was unrealized losses in bonds, just as the pace of customer withdrawals was escalating. So all of those things together created the perfect storm. And they announced on Wednesday that they had sold a bunch of securities at a loss, and they would also sell $2.25 billion in new shares to shore up the balance sheet. That's when companies started getting advised to withdraw their money from the bank.
I think that's what tipped it over.
The stock started plummeting. And by the afternoon, other bank shares got dragged down with it. Investors started to fear a repeat of the financial crisis from 2007 to 2008. And so what's going to happen next? Well, a lot of people are wondering, and some people are also thinking, is it safe for me to even put my money in the bank?
Right.
Well, President Biden did have a press conference, and here's what he had to say about what happened to anybody who had their money in Silicon Valley Bank.
All customers who had deposits in these banks can rest assured. I want to rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the Deposit Insurance Fund. Every American should feel confident that their deposits will be there if and when they need them.
All right, the FDIC, the Federal Deposit Insurance Company Corporation, they always tell you if your bank is not FDIC insured, do not bank there.
Right.
Said they will pay uninsured depositors an advance dividend within the next week, and that uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds. But like a company like Roku, for example, they had $487 million in Silicon Valley Bank. That's about 26% of their cash. So the future of those funds is now uncertain as federal regulators have now taken over that bank. They also took over Signature Bank too.
Yeah,
After that, by the way.
Yeah, so there's a second bank.
Signature.
The Signature Bank, yeah.
All right, now here is what Joe Biden, though, had to say about if you were an investor in this bank. It's different than if you were just banking there. What if you invested?
The management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works.
That's accurate.
Yeah, so if you invested, that's that.
Yep.
All right, well, that is your Under the Radar. And again, Art Hogan is going to be joining us. He's going to give you more comprehensible information on what's going on. What's up? It's Way Up with Angela Yee. I'm here with Jasmine Brand, and we have Art Hogan, Chief Market Strategist for B. Riley Financial, on the line. Good morning, Art. How are you?
Good morning. I'm doing great. How are you?
I'm good, thank you. And we have a lot of questions because we're watching what's happening with Silicon Valley Bank and also now Signature Bank. And we're wondering, just in layman's terms, how can something like this happen? How does a bank collapse?
Well, I'll tell you this. What typically happens is a lot of money decides to leave a bank at the same time. So regional banks have regional exposures to different industries. Silicon Valley, obviously very exposed to things like startups and venture capital, and they had a very rough year. So a lot of those companies that thought they were going public didn't get that capital infusion and started pulling their money out of the bank. When that happens, the bank has to take its liquid assets and sell them. But unfortunately, Silicon Valley's liquid assets were in treasuries that are now worth less than they were 2 years ago when they bought them. So they took a loss last week. The exit of depositors got even faster, and the feds had to close the bank down because they were just in a liquidity crisis over the weekend.
And now, how do rising interest rates also contribute to this?
So the rising interest rates contributed in two ways. First, it made a lot of those venture capital companies less valuable. People are willing to pay less for long duration or profitless technology companies, and that collapsed the IPO market. So none of their venture investments came out to the public markets last year. The other piece of the puzzle, though, is that the higher interest rates made the treasuries you bought last year less valuable this year. So if you bought a 2-year treasury that was yielding 2% last year and then it got up to 5% last week, you have to take a haircut when you sell that to pay back those depositors. So rising interest rates actually hit them twice.
Wow.
So how does this affect the average person like me who I don't bank at either of these banks? Does this affect the average person that doesn't bank at either of these banks?
It doesn't affect you. The FDIC, if you're in a bank, the FDIC insures your deposits before this weekend up to $250,000.
Right.
The FDIC opened that up and is now going to insure all depositors, regardless of how much money you have in an individual bank. So the depositors are not going to get hurt.
Okay.
If you're an investor in some of these banks, you're going to lose your money because the equity won't be worth any money.
Gotcha.
All right. Now, we saw that, like, say, Roku has a lot of their money. I think, like they said, 26% of their cash in Signature Bank. So is their money only insured up to $250,000?
It was until this weekend,
Okay.
and now it's not. So depositors are going to be protected by the federal government, but the banks themselves are not going to be rescued. The banks are going to go under the waves. Depositors will be protected.
And that's not coming from taxpayer dollars, right?
That's actually coming from the banking industry. The banking industry actually funds the FDIC. They have a pool of capital for emergencies like this. They've expanded how much protection they're going to give, and that's not coming from taxpayers. It's actually coming from the banks themselves.
So what happens to Silicon Valley Bank after this? Now that the government is taking over, will it ever get back to a place where they're back, or is it just, okay, they're going to just handle the situation and go away?
They're going to handle the situation and likely sell off the pieces. So their London branch, for example, over the weekend was sold to HSBC. We'll likely see more of that happening once the Fed gets through trying to figure out what they have for assets and what could actually be sold off to healthier banks. So they'll likely be broken up for the pieces, and that'll happen over the course of the next several weeks.
I see people pulling their money out of the bank in a frenzy, too, right now, right? The average person is like, banks aren't safe. And we've heard that a lot in our community, too. Some people don't feel like it's safe to put your money in the bank because what if something like this happens and then now I can't access my money, et cetera, et cetera. What are some tips you can give people when it comes to putting your money in the bank? I know you have to make sure it's FDIC insured, but what are some ways that people can feel more secure and safe about putting their money in the bank?
Well, I would tell you there's three things to unpack here. First and foremost, you hit it right on the head. If you have an FDIC-insured bank, and most banks fall into that category, including community banks, then you don't have to worry about your money. What happened at SVB, if that happened to your bank, you were going to get your money back. And that's even above that $250,000 limit. One of the problems with the rising interest rate environment, though, is some people that would normally use a bank are now finding things with higher interest rates like money market funds or buying treasuries from the Treasury Direct. And that's been part of the process of some of these banks losing their depositors. But the third thing to remember is the federal government and the FDIC and the Treasury wants to protect the individual, and that's why the FDIC exists. So if your money's in an FDIC guaranteed bank, you're not going to lose your money.
Okay, I have a question. Over the weekend, I was seeing initially that people were saying that they were scared that what happened in 2008 might happen again with this situation. Can you briefly explain what happened in 2008, and then is it likely at all that this can kind of have a domino effect?
Yeah, well, what happened in 2008 started almost a year ago exactly to when SVB, and that was Bear Stearns got into trouble. They had way too much leverage, so they were making too risky bets, and that collapsed. And then after that, we saw the same thing happen to Lehman in September. Since then, we've changed the rules for banks. Dodd-Frank was put in place to make sure things like that wouldn't happen again, so that we've increased regulation. We have stress tests for banks. They actually have to have higher levels of capital. So our banking industry is actually much stronger than it was back in 2008 and 9 for the exact reason for not having this happen again.
Okay.
Those regulations didn't extend all the way out to some of the regional banks, and some of that regulatory environment was lessened in 2018. That's why we ran into this trouble. I would be very surprised if regulations don't even get tighter. So I think our financial system is in much better shape than it was back in the 2008-2009 timeframe.
We learned our lesson.
Yeah.
And what about a recession? People are nervous that there's a recession going on. Do we have a reason to be nervous?
Well, I would tell you, people have been nervous about a recession for about a year and a half.
Right.
And it just hasn't come to bear, and I'll tell you why. We've seen a recession in things like housing. Prices have been down since July. We've seen a recession in manufacturing. It's been contracting for 4 months in a row. We're not seeing a recession in consumer-facing things like services. We have a very high level of employment. Consumer balance sheets are in very good shape and much more robust than they were pre-pandemic. So I would say 30% of the economy is in a recession, not the other 70%. The other 70% might eventually get a recession. I just don't think it's this year's business, and I think our concern has been overblown, and we've missed that call for a year and a half. I don't think this regional bank situation is going to thrust us into one.
All right, so we can breathe, right, Art?
That's one of the most important things to do right now, and not panic. You never want to take your money out of the bank and hide it in your mattress. It's probably the least safe thing to do.
I guess I need to put
The
my
FDIC is
money
there.
back in. I need to take my money from out the mattress. But listen, I have a question. This is something, Art, that Angela and I talk about a lot. Should we not keep a ton of money in the bank? Like, say I have, I don't know,
$500,000.
Say I have $500,000 in the bank, just sitting there, just not doing anything. It just kind of sits there because it makes me feel good. Is that not a good decision? And it's FDIC insured. Let's say that. Well, it is. But is that something we should not be doing? Because Angela's point is...
I'm always like, you got to make your money work for you. If you have that much money in the bank, it's not working.
And so, Art, what do you say?
That is a very high percentage necessarily of your liquid assets to be sitting in a bank collecting the lowest of interest rates. Now, before this weekend, I would tell you if you had $500,000 in a single bank, you might want to put that in two banks because $250,000 was the limit of your protections by the FDIC. But I think to Angela's point, you want to have that money working for you. You want to have a diversified portfolio that is actually going to earn you more over time, because very rarely will whatever a bank is willing to pay you for your deposits keep up with the natural rate of inflation. So your money's not working for you. It's actually working against you. It may make you be more comfortable,
Right.
and there should certainly be a percentage of your liquid assets that sits in a bank because of emergencies. Call it 6 months worth of your needs, but certainly not 6 years worth of your needs.
Yeah, the rate of inflation versus the interest rate you'll get is going to outpace that.
Yeah, and I just want to say that's not...
Sure is.
Go ahead. I was going to say that necessarily isn't a relatable number, 500,000, but something like 50,000, 100,000. I don't know what, I'm just throwing numbers out there.
Throwing a number out.
Yeah, I didn't want to say,
Anything crazy.
Yeah.
But yeah, I'm a big fan of if you have too much money in the bank, you should be, that money got to go to work. It's like your kids. All the kids in the house, somebody has to work.
Art agrees with your thinking on that. So, okay.
All right, well, I appreciate you so much. I really understand this way better now. And so I feel a little more secure in what's going on.
Well, hopefully we can have a conversation about this 6 months from now, and things will look a whole lot rosier than they do this morning.
All right. Well, I appreciate you. Thank you so much, you guys. And how can people follow you, Art Hogan?
Art Hogan, I'm on Twitter. You can find me on Twitter, Arthur Hogan III, and I post about my interns who happen to be dogs every Friday, so you're not going to want to miss that.
All right. Thank you so much for
you.
taking the time out. Way up with Angela Yee.